This conference will now be recorded.
This is Michael Lee from Deep. I'm going to go ahead and call the meeting to order. The first agenda item is public comments. Is there anybody from the public that would like to make a comment? All right, seeing none, I'm going to move to the next agenda item, which is the consent agenda. And the only item on the consent agenda is to approve the meeting minutes from the last meeting. Has everybody had a chance to review the minutes from the last meeting? Any questions?
I'll make a motion to approve the minutes. It's Matt.
Thanks, Matt. Can I get a second?
Binu Chandy, seconds.
Thank you, Binu. Any discussion? All right, all in favor, say aye. Aye.
Aye.
Any
Aye.
opposed or abstentions?
It's Lonnie. I'm abstaining because I missed the last meeting.
Yeah,
Thanks, Lon.
same for Steve Meyer.
Thanks, Steve. So Lonnie and Steve are abstaining. All right, so the next agenda item is the main event. I'm going to turn it over to Bert, and he's going to talk about a position that the Green Bank has in a fuel cell company and some proposals on what we're going to do moving forward with the position the Green Bank has. So with that, I'm going to turn agenda item number 4 to Bert.
Okay, thank you, Mike. I wanted to, yes, just walk through this. As some of you may know, the Green Bank has a few legacy investment transactions, and this one called Acumentrix falls into that category. These would be transactions that the Connecticut Clean Energy Fund invested in prior to the Green Bank or prior to the Connecticut Clean Energy Fund becoming Clean Energy Finance and Investment Authority and subsequently the Connecticut Green Bank. So what the Green Bank did was it entered into a memorandum of understanding with Connecticut Innovations to basically oversee these transactions. They just live until they die, if you will, these investments. There's nothing really actively going on with any of them, although in this particular case, it is an operating company. And so we'll just walk through this because the situation is that there are investors that are currently investors of the company, and they would like to simplify and rationalize the ownership structure. And I'll walk through that through this deck. And on this page, you see that the company Acumentrix, as I mentioned, it's up in Massachusetts. It basically has two businesses. One is the solid oxide fuel cell products group, and the other is the rugged UPS products group. The solid oxide fuel cell business has, as of last year, decided to be wound down, and so it's no longer continuing its activities. It's been all of the IP, et cetera, has been sold off, so there's nothing remaining to that business activity. And the other activity is this rugged UPS, and it's pretty much used for in the military. You see there's a picture of a plane dragging a drone, and so it has power systems that are powering the drone in flight. There are other purposes using these backup UPS systems for first responders, and in rugged environments, think of like construction sites or things of that sort. So that's the business. So what had happened years ago was that in fact, please go to the next slide. I think it might be set forward there. Yes. So what happened was many years ago, going back to 2002, as was explained in the memorandum that was distributed to the committee, the state of Connecticut, through the Clean Energy Fund, Connecticut Innovation, sought to attract the solid oxide fuel cell business to the state, and made an investment of $4 million in that endeavor. Actually entered into a supply agreement for certain products for another $1.5 million. Those transactions did not result in Ecumetrics actually moving to the state. It was the source of dispute and arbitration and controversy, even from an ethics position, as to how the Clean Energy Fund even ended up with this transaction in the first place, thinking that maybe there were some dealings between a member of former Governor Rowland's staff who had encouraged this type of investment, and maybe even directing the construction of a proposed facility under a no-bid contract, and all kinds of activities like that, which were explored and dealt with through the legal channels. And there were even reviews that CI undertook at the time. And keep in mind, we're going back 15 years when these activities were happening, but there was an investigation that was sanctioned by the board of the CI at that time. These things were investigated, they were referred to the proper authorities, and they took their particular route. But as it relates to the investment and the progress of that business that was sought, the products themselves suffered over time from a number of reliability issues. They were always challenged in terms of gross margin, and ultimately, because of the lack of performance or reliable performance and profitability, their bank lines of credit shrank and disappeared, and they had a last chance investment that was actually brought forward by the group that is proposing to buy out the shareholders in Ecumetrics at this time. But that effort failed, and they decided to close the business in May of 2019. Again, the rugged UPS business is strong. I described that, and the majority investors, who are Source Squared and Rick Piero, are desiring to simplify the structure. There are more than 36 unique owners of the company, some of them as small as less than 0.2%. So they're little dribs and drabs. And so my understanding is that they really want to simplify the structure, because to scale up the company will take more investment. They are offering shareholders a chance to put in more money if they want to. That's actually one of the options that is available to us. Although, let's go to the next slide. Here's the chronology. I really walked through this, so really don't have to go through this, except to say that we were a Series B preferred shareholder. The majority shareholders in the A preferred and the C preferred had the right given to them, or they negotiated when they put their money in the Series A and Series C, to cause all shareholders, regardless of class, to become common shareholders. I think that was in an effort, again, to really simplify the ownership structure. And as a result of all of those activities, as well as any settlement that was reached in the 2005-2006 period, the Green Bank, as it stands today, has 978,790 shares of the Class A common. And what is typical in these transactions, when there is a proposed buyout of any shareholders, you have to get a fairness, what's called in the trade a fairness opinion. And they did that. That was done by a group called Carta Valuations LLC, and that was in your board package. And that resulted in a valuation of 23 cents a share, which would result in a buyout price for the Green Bank of $225,000 and change. Next slide, please. So that fairness opinion went through its paces to determine the value of the company. It determined that the value is actually 42 cents a share, but they discounted that for a lack of marketability. The result being the 23 cents that I mentioned before. The finance team, me personally, performed a sanity check based on the earnings before interest and taxes and depreciation and amortization that was obtained from the recent information that was circulated. In looking at that and ascribing what I consider to be a sane growth rate based on what they've been achieving more recently of 20% a year, I concluded that that the proposed value that they arrived at 42 cents was reasonable. I think the real issue is, what do we think about the lack of marketability discount? Next page, please. So here are the options before the board, and keep in mind that the Green Bank only holds 1.18% of this enterprise. The options are to take no action, to continue to hold the common interest that would be received on conversion. Again, the majority shareholders of the A and the C preferred have forced that conversion, so that process has already been set into motion. So we should consider ourselves as effectively common shareholders, because this is going to take place on the 15th of December. We can elect to participate in the offer to buy a pro rata share, depending upon who is expressing interest in the purchase. I think that, and I'm not sure if Brian Farnan is on the phone, but I think it would be unusual for the Green Bank to devote.
I'm here, Bert.
Thanks, Brian. I think it would be unusual for the Green Bank to devote any more investment dollars to this activity. It doesn't fit with us strategically. It's an out-of-state based company. As far as I'm aware, there's no nexus of any activity in the state of Connecticut.
Bert, you were somewhat lucky to miss some of the technology innovation back and forth. It was really Brian and I in those early days when we transferred from the old Clean Energy Fund. There was the discussion on whether we wanted to continue doing these types of investments, and there was a lot of thought put in by the board, and we made the decision we only want to be dealing with commercially available technologies. The risk isn't worth the reward. It wasn't like there was a clean energy tech cluster in Connecticut, and the risk was probably not worth the reward here. So this is definitely the type of deals that we made a conscious decision as the Green Bank to step away with. And I think in hindsight, it was very much the right decision. And we focused on leveraging and attracting private capital, and Harvard Awards and all good stuff came out of that decision, I think. And
okay, so that's the second option. The third option is to sell our common shares at the offer price of 23 cents, in which case the total willing buyer pool will be allocated against the total willing selling pool pro rata. This transaction is set to close, as I mentioned, on the 15th of December, so next week. That's at least their plan. Is they have to get all their papers in order, et cetera, et cetera. And prior to that, we'd have to respond affirmatively as to which option we're selecting. So next slide. So this resolution has been prepared on the basis that the deployment committee goes along with staff's recommendation, which is to sell, keeping in mind what Brian Farnan just mentioned about this kind of, being not what the Green Bank is going for these days. And the fact that we have such a minority position in this company, there is no ability for us to influence any cash outcome should we retain our investment. Now, typically what happens in these transactions is the controlling shareholder will then do what they're going to do with the company, look to do some kind of an exit transaction, either with the sale of the company to another company, potentially an initial public offering, all kinds of possibilities. But the Green Bank is not going to be influential in that, with holding 1.18% of the stock. So that could go on for years. The view is, from a staff position, is that we could better use that money toward other activities. We mentioned in the write-up about devoting it to some LMI or vulnerable communities type of activity, and literally can just consider it to be found money, as we did with the Ash Center award when we won that a couple of years ago. So that's where we are. Happy to address any questions that the committee may have about this, and turn it back to you, Mr. Chair.
Thanks, Bert. Does anybody have any questions?
Mr. Chair, it's Lonnie. Bert, you had me at John Rowland. I think the staff recommendation is really, really good. Is December 15th the drop dead date? I mean, that they're all ready to go, and are we guaranteed to get that money, that the 225?
We've given the approval of not less than 23 cents a share. So if there is anything to be less than 23 cents a share, we'd have to come back to the deployment committee for approval. So it's either going to happen at 23 or better, or it's not going to happen at all without coming back to the deployment committee.
Great, thank you. Thank you, Mr. Chair.
Or under what circumstances would the price be above 23 cents?
I can't think of any. I guess if there were another reasonably significant shareholder, or some of the minor shareholders banded together and really decided they wanted to challenge the card evaluation, I suppose ultimately that could lead to a higher price. As I mentioned, there are, I'll just hold this up. This is the list of shareholders, if you can see that on the screen.
Yep.
But there actually, as many as there actually seem to be, as I went through that list, 37 or 38 unique shareholders, because there's some shareholders that bought in various classes. So even though they mentioned that they have like 80 shareholders, it's really, they actually duplicated the ownership that they really are keeping track of. It would require so much, I think, coming together. I would think it's a low probability event that anybody kind of questions this at this time. I think that people will either say they're either going to fall in the camp of sitting where one of the three options: sitting where they are, putting up some money, or getting out.
Bert, this is Matt. I have some just questions, and maybe they're for Brian as much as Bert. Just to make sure we're doing this right, under the bylaws, I assume this is a deployment committee action and not a board action because of the authority to essentially dispose of investments under the bylaws. But my question is, it also seems like it's kind of a loss, a write-off, because it seems like this was valued at $4 million at one point when it was the settlement was resolved. So what about that? I mean, should this go to the board, or is it really ours to approve under the other policy about write-offs? Will this be treated as a loss?
Well, it will not. And before I turn it to Brian Farnan, the board has, through the ACG, is it ACG? Who signs off on the financials? I'm sorry, Brian Farnan, every year.
Oh, the ACG, the CAFR.
Yeah. So
This is a $1 value for this, right?
So the ACG and the board over the years have signed off on valuation adjustments to the investment, and the most recent was to bring it down to $1, and that was a few years ago. And that's on the basis of recommendations we get from CI. So actually, the board has recognized a diminution of value over the years. So it's fully recognized that, and so I think that I'll defer to Brian Farnan on this. But I think that we will, for financial statement purposes, recognize a gain of $225,000, and so I think that it seems to be within the purview of the deployment committee, given the size.
Yeah, this is Brian. I'd agree with Bert's assessment. I think the fact of the matter is, if we currently had this valued at, say, $3 million or $2.5 million, and then we were coming to the deployment committee with this lower valuation, I think we would have an issue. But because it has for some time now been valued at $1, and now we're selling it off, I feel like it's okay to do that.
Okay, and I guess I think you answered my other questions, but the sort of related question was, if you want to comment on it, is just from an audit point of view, if putting your state auditor goggles on, are they going to look back at any of that devaluing and then selling? Is there anything we need to do to make sure that we've dotted our I's and crossed our T's so we don't get dinged from that perspective?
I don't believe so, Matt, because I think all those valuation adjustments have been done in concert with CI, and they are certainly more expert in valuing companies than we are. We submitted this memo to them with our assessment. They said they see it the same way. They wouldn't change anything in the memorandum or the write-up or even our decision, or our recommendation. So I think that we're in good shape in that regard. But Brian Farnan, do you have a thought on that?
So I'd agree with Bert's assessment with a little bit of a caveat. So we had the independent valuation. We reviewed it. CI reviewed it, which we engaged them under the MOU. Sometimes with the auditor, you never know. I feel like we did what was reasonable. I think of the example when we had a CPACE promotional program where there was if you did X, Y, and Z, you would receive, when we were paying for, we were writing off certain early costs. And it really was like a business decision to do that. And the auditors came in and said, why are you doing this? And I was like, what do you, like, you're an auditor, you're stepping outside your lane. I mean, there's always that chance that the auditors take and usually I think they're good. Sometimes they do take an area. I'll check the minutes afterwards on this, but I do sometimes think that they take unrealistic stances. I think we're on solid ground here, though, for what it's worth.
Okay, that's fine. I don't want to belabor it. And last thought is maybe in the resolution after the for a share of not less than 23 cents, as explained in the memorandum dated December 11th, including but not limited to the CARTA evaluation or something. Do we want to reference that just so we don't have to go back digging for it, that it's mentioned in here?
I think it's in the whereas clause in the write-up.
Okay,
but if it isn't, let me just check real quick.
This is Binu
Yes,
Chan.
it is. It is the third whereas. It mentions card evaluation. So
All right, thank you.
This is Binu Chandy. In the whereas clause, is it also included about the, the devaluation to $1? If that's also included, that would help.
it is not a good point. We can include that. Let's see. Background. Let's see. We could put it. I think I'll put it at the end of the second whereas clause, which says, whereas Greenbank and other shareholders of Acumen receive a proposal to buy the 790,000 shares of common stock, the shares Greenbank owns, which are held of record by Connecticut Innovations Incorporated, CI, for the benefit of Greenbank, for a price of 23 cents, for a total sale price of $225,121.70, which would result in a gain for Greenbank of 225, 120.70, taking into account the existing carrying value on Greenbank's books, financial statements of $1. How about that?
Great.
Great, thank you.
Okay. All right.
Mr.
So we
Chair,
will make that
Steve
adjustment
Meyer.
to the whereas clause.
Sorry to interrupt. And Mr. Chairman, this is Steve Meyer. Just a question around the discount for lack of marketability. Is 45% commercially reasonable? Is that pretty standard for this type of private company?
Steve, I cannot offer whether that is a standard. They did go through a particular analysis on that point in terms of referring to standard methodologies. They gave those methodologies for determining a lack of marketability factor in their valuation. It was thorough, it was exhaustive, and honestly, I personally was not in a position to challenge it. Our friends at CI did not challenge that either, so we accepted it. We're accepting it in our analysis.
Okay, thank you.
Mm-hmm.
All right, any last questions for Bert? If not, is somebody willing to entertain a motion for approving the resolution with the subject to the additional language about the $1 valuation?
This is Matt. I'll move the motion, the resolution as amended per what Bert read off on the $1 valuation.
Thank you, Matt. Can I get a second?
This is Steve Meyer, second.
Great, thanks, Steve. Any discussion? All those in favor, please say aye. Aye.
Aye.
Aye.
Is anybody abstaining? No abstentions. Is anybody opposed? No opposition. Motion passes. Thanks, Bert.
Okay, thank you very much.
Does anybody have any last?
Nice money to find under the couch cushions. Right, Bert?
All right.
All right, anybody have any last comments before we adjourn? All right, motion to adjourn.
So
moved.
moved.
Second.
Excellent. Thanks, everybody.
Have a great weekend, everybody.
Thank you. You
Thank
too.
you. Bye now.
Hey, guys.